Hey guys, thanks a lot for watching. In this video, I'm going to talk about how to build a bulletproof crypto portfolio and how to develop the mindset of a crypto millionaire. Constantly, we hear the story of people who have got rich quick in crypto by buying this 1,000 ranked altcoin. But what about the people that haven't made it? We need to realize that in crypto, there is an investing hierarchy. The top of the food chain is the actual company. Below that, you have the VCs that invest early in them. Below that, you have YouTube influencers. And then below that, you have retail investors. So as you can see, retail investors hear about projects. They are the last people to really know about fundamental issues. So you have to keep that in mind. And anything can happen to any project. And if you were to really manage for example, your grandmother's fund, would you really put it all in a low cap gem? I think a better approach is to have a structured crypto portfolio that can stand the test of time. I also speak about this approach of active investing as opposed to passive investing, and I will talk a bit about that later. Active investing is more about buying good fundamental companies, but accumulating lots of units of them, as opposed to just passively investing and buying and holding. If you bought crypto in 2020 and just held everything up to now, you would be at break even, if not at a loss. But if you focused on accumulating lots of units, so more efficient investing, so active investing, you would actually have more stack of the actual project that you're interested in. Something to also realize is that projects change, the markets evolve. The top 20 in 2017, some of the projects are nowhere to be seen now. For example, you have things like Bitcoin Cash, you have EOS, which was supposedly a project with big hopes, but in this last bull run, and even now, you don't hear anything about it. So you need to realize that markets evolve. So when structuring a crypto portfolio, I'd recommend at least 40 to 50% of your spot or investing portfolio should be blue chips. So for example, Bitcoin and Ethereum. Bitcoin and Ethereum seem to be the common denominator. They've stood the test of time up till now. And we could always have that .com flush, where all the garbage projects get flushed out. And usually speaking, when that happened, it was the Amazon, the Microsoft, the Google that generally stands the test of time. So in this case, Bitcoin and Ethereum, you might vary that percentage, but roughly 40-50%. Then I would say 20 to 30% of your portfolio max should be altcoins, like good altcoins that are industry leaders. For example, I can only speak for myself. For example, I like Sandbox. It was a leading industry metaverse coin. I also like projects like Quant. I'm not affiliated with them, but I just like the project. So it's just looking for projects and again, accumulating lots of units of the project rather than just buying and holding. I'm going to speak a little bit about more active investing as well, but I want to say for this allocation, I would say 20 to 30% and more top 100, 200 altcoins, I'd say. You can invest in smaller microcaps, but I would say within that 20, 30%, I would say at the most 2, 3, 4%. And you can always reshuffle your portfolio. If you get a small gem and that 100x's, you can always reshuffle, and from those profits you can accumulate more. But you have to be disciplined and you have to preserve capital. You have to preserve your portfolio as well. You cannot just go all in on an altcoin. The next thing I want to talk about is derivatives and active trading. So I would recommend 25% of your portfolio goes here. Derivatives and active trading is actually the most important thing for me particularly, because that is capital preservation. It's how you preserve your capital. You can take profits, and once you get really good at trading, you can preserve your capital and grow it consistently over time. I also think understanding technical analysis is very important to people who disagree, because, for example, last year in the crypto chart, if you understood basic technical analysis, whilst you would not have predicted the top to sell, you could roughly predict when to start shorting Bitcoin. So for example, in this chart, we had this peak. If you understood technical analysis, you would have actually been able to tell this was a false break. This was the initial high that we've pulled back down. This was just a deviation of false break. Obviously, in hindsight, it's easy. But whilst technical analysis will not allow you to time the top, it gives you some idea of when to sell. And for example, in this specific situation, if you understood technical analysis, you would have been able to see, okay, this was the beginning of a head and shoulder formation. Once the neckline was breached, you would have been able to start shorting. So roughly around 50k. So it's just technical analysis is actually important because it helps you to really understand key market levels, order blocks, and also more efficient DCAing. I disagree with the notion of just DCAing blindly. Because if you had DCA'd Bitcoin from the top here, 70k, 50k, 40k, 30k, yeah, okay, fine, you were consistently buying, but it's not particularly efficient because it was slightly overvalued here. I think it's more about buying. No, you can't buy the bottom, but I like to buy more with an upward momentum. In bear markets in particular, the goal is not really to buy the dip, in my opinion. The goal is more to buy the dip to sell the rip. And in particular for active trading, so this 25% for active and derivatives trading, I would stick to pairs with really high volume. For example, Bitcoin, Ethereum, or maybe other pairs that you like as well that you really understand. But what I would say is don't be the kind of person that tries to trade 30, 40 altcoins. I've been there and it does not work because the best traders I know are people that stick to 3, 4 pairs max, some cases 1 or 2. I particularly mostly just trade Bitcoin and Ethereum because by doing that you get to know the key support levels and resistance levels of those pairs at the back of your hand. If someone wants to ask you right now, what all pairs do you trade? And if right now you cannot tell what's the current price of all those pairs, you're probably trading too many pairs. If someone asked me right now, what's the current price of Bitcoin and Ethereum, I'd be able to tell you. Because I'm mostly sticking to those pairs. And also you want pairs with high volume. Especially in bear markets, sometimes it can be a liquidity crunch. So for you to sell something, there has to be a buyer. For you to buy something, there has to be a seller. It's just market making dynamics. So the last portion of your portfolio, I would say, is ICO investing. And this again, I would say 5% of your portfolio at the most, and you can split that 5% across 10 different projects. Because you need to realize that not all projects are not going to make it. You have to treat this like a VC approach. If you have 10 projects, 3 might 100x. Say 3 or 4 or 5 go bankrupt, and then 2 might do average. The 3 that 100x will compensate. They'll also give you more opportunities to do the same process again. So you can get wealthy by having high risk reward and consistent structured crypto portfolio. You don't have to go all in on one thing. Sometimes things might not work. A really good project that worked well for me last bull run was Matic and Harmony One. I got 100x's on those, and Sandbox as well. But things change, markets evolve. You can't get too attached to projects. The top 20, for example, AVAX did quite well in the last bull run, but it doesn't mean it's going to be there in the next bull run. Next bull run, it might not be in the top 100. Markets evolve. The needs evolve. Technology improves. So you have to constantly do research. Another thing I want to say is fundamentals of a project are not enough to invest for the long term. You also have to look at tokenomics. If there's a coin that, for example, is a good project, but they have a really low circulating supply to the max supply, then that's a red flag for me. A particular project that caught my interest was Algorand last bull run, but I never invested in it, and I made the right decision. And why? Because it had a very low circulating supply. What that means is that if there's a low circulating supply, that means that more coins can be dumped. And so you will be diluted and the actual price will go down. My general rule of thumb, I think is a good rule, is if I like a project, I like the circulating supply to be at least 50%, ideally more of the max supply. I will talk a bit more about this in future videos, but it's important to really look at these tokenomics and see when the release periods are and lockup periods for these VCs and people, these early investors, a 10% cash position. This is so important because you want to always have the ability to buy the dip. I've learned in crypto, you should never be all in and you should never be all out. Even when you think the bottom is in, believe me, the market can go much lower than you can remain solvent. And what I talk about this 10% cash position is that you need to rebalance it all the time, especially when you make gains in portfolio. But using this as an example, say you had a 50k account, 10% cash of that would be 5k. So you could put that in stable coins or in actual fiat. In a 50k account, that 10% would be 5k. But then say you had some really good investments and your 50k doubles into 100k. That 5k initially out of 100k is now 5%. So you have to reshuffle. You have to take profit somewhere so you're able to rebalance it and make the 10% of the 100k, which in this case would be 10k. So once that doubling happens, 10% of 100k would be 10k. But then say your portfolio then goes from 100k to 50k. Say there's some black swan events. Then you would have 10k in cash, but your portfolio will be worth 50k. But then that 10k now is 20% of your portfolio. So I would try and at least sell half of that portfolio so you can rebalance it and then have 5k for the 50k, which is now the new 10%. And I'll give an example here. So if we go back in time to memory lane, when we had this huge run-up in Bitcoin, okay? So pretend we're at this point and your portfolio value is 50k. You have 5k in cash, which is 10% of your portfolio. Then there's a big bull run, this run up here. Your portfolio value is now 100k, but you only have 5% in cash. So you should take at least 5k profit out of your gains, so you can have 10k, which is 10% of your portfolio in cash. Obviously, in hindsight, you should have taken out a lot more, but this is just an example to highlight the importance of always having some cash. And if you notice, we went dumped here. All the moon boys got really optimistic. I still had some cash position here because I thought to myself, okay, I want to always have some cash exposure in case we dump. So we fell down here. Everybody thought this was a dump in June 2021, but I had some cash position. So if you have that 10% cash position, you would have been able to deploy the dip here. And what do you know? We had a run up here and a run up here. And again, you take some profit out of the gains, and you have to always maintain a 10% cash position at least. Some people maintain a 15%. A lot of it depends on your age as well and your risk profile. For example, if you are someone who's a lot older, like in the 70s, 80s, 90s, your risk tolerance is a bit lower than someone, say, who's in the 20s, 30s. So it all depends on your case-by-case scenario. In this last example, I also talk about active investing, and I'm going to go through that now. See, there's two types of DCAing. There's a lazy DCA. It's almost become like a meme now. Buy the dip, buy the dip, buy the dip. If you had bought the dip here, it would have kept dipping. If you had bought the dip here, it would have kept dipping. If you had bought the dip here, well, it's going to keep dipping. So it's kind of become a meme. Nobody can 100% tell where the bottom is, obviously, but you don't want to keep buying the dip that keeps dipping. A more efficient strategy that I'm going to outline, you might find it useful, but this is what I think is quite interesting. So I do this particularly for blue chips like Bitcoin and Ethereum. The first thing I do is find a run-up of 50%. So if we start in the June lows, this is a run-up of 44%. Okay, 45-50% roughly. Then I mark this custom Fibonacci. It's not the usual Fibonacci, it's just my custom made one. So I do that, and then I'm just going to put in the features. Okay? I know it's a bit hard to see, but if you notice, so there's run up of 45% roughly from 17.5k to 25k. So I'm looking for a dip of 10%. I'm going to DCA in some. Another dip of 10% is down to minus 20%. I can DCA some. Another dip of 10%, I can DCA down to 30%. I have the ability to DCA all the way down to zero pretty much. But instead of DCAing equally, I DCA 25% more incrementally each time. So for example, say you had 100k portfolio as an example, you might put in 6k in this first dip, then 8k, then 12k, so incrementally 25% each time. By doing that, you are lowering your average. Then the next thing is, say Bitcoin dips all the way down to, for example, 12k. Your average at this point might be 16k. Once Bitcoin increases in value by 50% from your own average of 16k in this example, then you sell off 20%. If it goes up by 50% again, you can sell off another 20%. If it goes up by 50% again, you can sell off another 20%. Then when the same process happens, when there's another run up of 50%, and then there's a decline, you can use those profits to incrementally accumulate more units. So this is more efficient investing. So I'm going to use this diagram as an example. Okay, say there's a run up of Bitcoin of 50%. I'm not going to FOMO like a moon boy. I'm going to wait for a dip. Invest in a portion here. I won't have room to invest all the way down to zero. It might not happen, but it's better to not use all your capital than be in a position where there's a dump and you cannot take an opportunity. You never want to be all in, you never want to be all out. So I'm DCAing all the way down. Okay, my last orders didn't fill, but my average at this point might be, say, 15k. It's gone down to 12k. Then once Bitcoin goes down up by 50% from my average of 15k, so say 22.5k, you can sell off 20%. If it goes up by another 50% from average, so say 32k roughly, then you can sell off another 20%. If it goes up to 45k, you can sell off another 20%. Then, so say there's a run-up of 50%. It might be a much higher run-up. If it's a less run-up than 50%, I might be less inclined. So say there's a run-up of 20%, then I'm not going to bother that much. But say there's a run-up of 50%, then we decline again. So do the same process back here. I use those profits and I keep accumulating here. So by using this smart, efficient scaling in and scaling out DCAing, I'm accumulating lots of units. But it's just to highlight the importance of constantly rebalancing your portfolio. One of the reasons why last bull run things might not have gone according to plan is because you fail to take profits and you fail to rebalance your portfolio. Remember, the ultimate goal here, of course we love crypto, but hopefully it's to provide a better life for you and your families. If you go to the petrol pump and if you're going to actually put fuel, you can't pay in Polkadot. You can't pay in Avalanche right now, as far as I'm aware. Eventually it might happen. If there's a huge run-up and you've made gains, you need to at least rebalance your portfolio. You need this level of discipline. You have to treat this like a business, I think. But let's not forget the ultimate goal here. Let's not get stuck up in the narratives that people sell us in YouTube. You need to realize that everybody has an agenda. And sometimes people are promoted to promote certain crypto projects. So always do your due diligence. And always try and be one step ahead of the curve. And I hope this video has been helpful. Please do check out my other crypto videos. I talk about things like risk management, also my Bitcoin analysis, and various other skills like shorting and just effective crypto investing, and just really to help you become a crypto millionaire pretty much. Stuff like this isn't really taught on YouTube, and I wish it was taught to me, so I'm trying to help out as many people with their current learning curve as possible. I've been trading now for 10 years, and I've made mistakes, but I'm really enjoying it, and thanks a lot guys for watching. I'll catch you in a bit.